Good afternoon. My name is Desmond Lochman, and I'd very much like to welcome you to this afternoon's event, which is on a bubble event that we repeat. We had this last April, and we're now repeating it again. I'd very much like to welcome our panelists, Tobias Adrian, Jeffrey Frankel, and Bill White, as well as our moderator, Alex Pollock, for agreeing to come back to share their views with how they see the situation right now. It would be a great understatement to say that a lot has happened since our last meeting in April, both to the global economy and to world financial markets. We now know that the world suffered its worst economic recession since the Great Depression, with no economy having been spared from the ravages of the pandemic. We also know more recently that the world economy appears to have rebounded very strongly from its deep slump as the lockdown restrictions were lifted and as the economies benefited from very strong fiscal and monetary policy stimulus. However, we do not know for how long this recovery will be sustained, especially should there be a second wave of the pandemic, and we seem to be seeing signs of that, at least in Europe right now. As to fiscal and monetary policy support that the world economy has received, it has been on a scale that has had no peacetime precedent. Governments around the world have responded to the pandemic with massive increases in public spending, and the issue of rapidly rising public levels of debt has not been politically considered. It's been postponed to worry about later. This event, on the other hand, will worry about rising public debt levels today. Meantime, in an effort to support financial markets and to provide monetary support for the economy, central banks have opened the monetary spigots on a scale that well exceeds that which occurred in response to the 2008-2009 Lehman crisis. As an example, in the space of barely 4 months, Jerome Powell's Federal Reserve has increased its balance sheet by around $3 trillion, or about 75%. Just to put the speed of that increase into some perspective, it might be recalled that it took Ben Bernanke's Federal Reserve around 7 years to increase its balance sheet by similar $3 trillion. So we're talking about monetary expansion on truly a dramatic scale. No less remarkable have been developments in the world's financial markets. After suffering the fastest 30% decline on record, world equity markets have staged their fastest and strongest bull market on record, thereby practically recovering their pre-pandemic levels. Similarly, after having totally frozen in March, world credit markets have strongly recovered, with interest rate spreads on riskier loans having tightened substantially. All of these financial market developments have induced the Bank for International Settlements last week to express deep concern that stretched asset and credit market valuations might have become disconnected from underlying economic fundamentals. In short, the world economy and global financial markets have very much entered into uncharted territory, for which reason I'm most grateful that we have with us this afternoon a panel of real experts to try to make sense of a very challenging world economic and financial market environment. In the order in which they will speak, they are Tobias Adrian, who is Financial Counselor and Director of Monetary and Capital Markets Department at the International Monetary Fund; Jeffrey Frankel, who is the James W. Harpel Professor of Capital Formation and Growth at Harvard University's Kennedy School. He is also a research associate at the National Bureau of Economics Research; and William White, who is a senior fellow at the C.D. Howe Institute in Toronto, Canada. And before that, he was the chairman of the Economic and Development Review Committee at the OECD in Paris. how we're going to be conducting this event is to have our panel discuss in sequence the following 4 questions. First question would be, how have the world central bank's policy response to the pandemic affected global asset prices and world financial markets? The next question is, how have some economies managed to weather the COVID-19 shock better than others? And which are the economies best placed to stage an early and sustained recovery? Third question, what are the likely long-run economic and financial consequences of our presently very high debt levels? And what are the policy options for dealing with such elevated debt levels? Fourth, how likely is it that we'll have sovereign debt or financial market crises in the Eurozone and the emerging market economies that could have spillover effects to the rest of the world economy? This is quite a full agenda. So without further ado, I'll hand it over to Alex Pollock, my longtime collaborator in these events, to say a few words and to moderate the event. I hand it over to you, Alex.
Thanks, Desmond, and it's great to be with you as always. I think this is a most timely and fundamental discussion, and I look forward to the thoughts of our excellent panel on the questions. Let me add my welcome to all of them and to all the participants in this video conference. The celebrated investor Benjamin Graham, as you may recall, said that the stock market, or we could say more generally financial markets, are a voting machine in the short term and a weighing machine in the long term. As we contemplate a global asset bubble in a weak world economy, as the title of our conference says, which of these two financial market machines is operating? Our discussion will proceed as follows. I'll pose the question to each speaker, who will then have 10 minutes to discuss it. And then the panel will consider the issue for 7 minutes, and we'll repeat that 4 times. Members of the audience may send in questions at any time by following the questions on the event page, either by email or by Twitter. When we get to the end, there should be about 15 minutes for general discussion and consideration of any points that we haven't taken up yet, and we will adjourn promptly at 3:30. Let's begin with Tobias and question 1, which is, I remind you, how have the world central bank's policy responses to the pandemic affected global asset prices and financial markets? Tobias.
Yeah, thanks very much for having me. It's very good to be back on this panel and discuss a question we considered about 6 months ago. And of course, as Desmond pointed out in his opening remarks, markets have turned around very, very abruptly. So let me share my screen to give you a little bit of the facts of what has happened. Here we go. So a global asset bubble in a weak world economy. And as was mentioned already, this is one of the sharpest recessions on record. Pretty much every country in the world has negative growth, and very, very sharply negative growth in many countries. There are few countries that do have positive growth. There are some, including one very large economy, which is China, of course. So let's turn to the asset market. So my talk is going to be mainly about asset prices. And what I'm starting with are financial conditions. So these are here expressed in units of standard deviation. So think of that as an average cost of risky capital in the economy. So this is an average of credit spreads, but also equity market prices and risk-free rates, as well as housing prices. And so what you can see is that in early 2020, as the COVID crisis hit, financial conditions sharpened very tightly. So the United States here is in black, and that was easy at the beginning of the year. And then it went from -1 standard deviation, which means it was easy, to about +2 standard deviations. So it was a delta of 3 standard deviations. And so the speed of tightening was very extreme. It was comparable to the global financial crisis. But then what was even more amazing was that the reversal was just as quick. So you can see that in the United States, we are back at very easy financial conditions. In fact, in other advanced economies, such as the Euro area, we have also seen quite a bit of easing of financial conditions, not quite as dramatic as in the US. Whereas in China, actually, financial conditions are moving sideways. And the right chart shows you decomposition of financial conditions into components, corporate valuations in red, interest rates, so this is the proxy for the policy interest rates, and then external costs. And clearly for advanced economies, including the US, the Euro area, and other advanced economies, it's the corporate valuations that were so dramatically contributing to the tightening of financial conditions. While overall throughout the year, rate cuts and easing of monetary policy has contributed to an easing of financial conditions. Housing hasn't played a big role around the world, as is indicated by the yellow, and that's very much different from the 2008 crisis. For emerging markets such as China and other emerging markets, it's actually the global financial conditions or the external costs of funding that really caused the sharp tightening. And so here we're showing you different asset classes. So on the left, it starts with equities, major indices such as Euro area, emerging markets, S&P, Nikkei, then sectors such as energy, airlines, hotels, commodities, foreign exchange, and then credit spreads and funding spreads and bond yields. And so what you can see in the risky assets is that you had this tremendous sell-off, right? So equity prices went down by 30% for the major indices and by close to 50% for the hardest hit sectors such as energy, airlines, hotels. And of course, for the Brent, so oil went down by over 50%. But since March 23rd, which is when the Federal Reserve had its major policy announcement, so March 23rd is when the Fed announced the special facilities and the major expansion of purchase programs. You can see that since then, that was the depth in most risky asset markets. Since then, asset prices have rebounded. And that's true for equity markets in most sectors. Of course, airlines have not rebounded, but energy has even come back, and credit spreads have come back. So it's an amazing down and up this year. And the key question is, are valuations stretched? And so this is what you see on this chart. So we show you the outputs from asset valuation models on the left chart for equities and the right chart for bond spreads. So these are fair value models that basically ask, are asset valuations misaligned? And you can see that either in return space or in price space. So for example, US equities are about 5% at the end of Q3. So this is just before, so this is updated as of last Friday. So as of 2 days ago. So you can see that the valuation that we detect is about 5%. And the red dot shows you the percentile of the valuation. And this is at the 90th percentile by historical standards since 1995. And you can see around the world, these equity markets are stretched. And the percentile is oftentimes between 80 or 90%. Same thing is true for the credit spreads. And there, of course, it's the other way around. When credit is stretched, then spreads are very tight. And you can see that in many, many markets, you're at the 10th percentile or so. So yes, valuations are stretched. And that is despite the recent sell-off. So the left chart shows you the S&P 500 for the US, investment grade bond ETFs and high yield bond ETFs. And so the investment grade bond ETFs recovered actually extremely quickly. And remember, that was of course part of these announcements on March 23rd. And the high yield bonds are not fully recovered. And that's related to the fact that there is a lot of solvency risk in the economy. So you wouldn't expect a full recovery. But equity markets totally recovered, and they overshot to some extent and came down, and they're basically flat for the year for the S&P 500. The right-hand chart shows you the spreads, and again, year-to-date spreads are a little bit wider by about 100 basis points around the world, but you know, they were wide by 700 basis points, and now they're barely 100 basis points wide. And it was said already that the contributing factor here, of course, is the policy support. So the left chart shows you the G10 central bank assets. And you can see this amazing, amazing expansion of balance sheet size. So these are the asset purchase programs. So for the G10, so for the US, it was about 3 trillion. And for the G10 as a whole, it was closer to 9 trillion. So this is a massive balance sheet expansion that was very quick. And it was very often not just in treasuries and sovereigns, but also in risky assets such as corporates. And so the right chart shows you that even emerging markets have started to do asset purchases. So here we are not showing dollar amounts, but rather percentages of GDP. And you know, some of these emerging markets have 3 or 4% of GDP of asset purchases, and some of them are indeed in risky asset markets. So the key question, and this is my last slide. The key question is this intended, right? Are the asset valuations an intended consequence of monetary policy? And to some extent, the answer must be yes, because asset purchases are transmitted via easing financial conditions. But of course, the corollary to this question is, what's the magnitude of stretched valuations that you think is reasonable? And this is, I think, where one might disagree, whether the amount of stretching is worrisome. And then in June, when we came out with our global financial stability update, we did warn of the stretched asset valuations and the danger of a sell-off. And that's exactly what we have seen in the past 2 weeks. Now, having said that, when you look at on the left chart here at the consensus earnings forecasts, you do see a very strong recovery. It is a lopsided recovery, so you don't recover to the pre-crisis trend, but it is very sharp in terms of growth rates. So with that, let me stop sharing my screen and turn it back to Desmond.
Thank you, Tobias. It really should be Alex who should be moderating this.
Desmond, I think I'm on now.
Oh, okay, great.
We did the unmute button twice, and it seemed now to have worked. Thanks, Tobias, for a very interesting overview of these asset prices, and we understand this valuation problem and the contrast which the title of the conference highlights. Let me open the floor to any member of the panel who'd like to take up any of the points Tobias made, either as a question or further comment, disagreement, or agreement. Anybody? I think we can put all the panel on now. AEI.
Alex, can you hear me?
Yes.
Okay. I just first want to thank to really very comprehensive overview of what has been going on. But maybe I could ask him one question, just in terms of what are the assumptions underlying the valuations,
Yeah.
and whether it could be that markets are being far too complacent about a number of things. So for instance, if I look at the United States, are markets really taking into account that it's very likely that we're going to be getting a second wave of the coronavirus occurring? If we get the second wave, it means that we're not going to get the recovery that these people are expecting. You could get the recovery stalling. The other question is the same we could say about the stimulus package. With the political developments going on in Washington right now, it's very unlikely that you're going to be getting a stimulus. Markets are factoring that in. So, the valuations could be underrated for that reason. We could have more overvaluation than we otherwise would have thought. And I guess the second point that I'd make is it looks like the central banks are doing the same thing that they've done before, riding into the rescue, but then actually compounding the problem of misallocation of capital. So for instance, I'm just finding, if I look at all the emerging markets, for instance, that their fundamentals are truly horrific, yet you're not seeing it reflected in spreads at all. In fact, these people seem to be able to go out and borrow some more money. So we're getting compounding these distortions that we might have to pay for later on. Those would be the two comments I'd have.
Tobias.
Yep, happy to give a quick answer to both. So in terms of the valuation model, let me walk you through the equity valuation model. So it's a model in levels. So we explain the level of, say, the S&P 500 with forecasted earnings. So this is from IBIS. So we pull the earnings forecasts, we regress the level on the forecasted earnings, and those are co-integrated in econometric terms. And then on the earnings forecast dispersion. So you can think of that as a type of a risk premium. And then, of course, on the level of interest rate and the slope of interest rate. So the monetary policy is proxied by that. And the residual from that is our metric for stretching. So basically, if valuations are high, if asset prices are high, or equity prices are high relative to forecasted earnings, relative to the uncertainty as measured by earnings forecast dispersion, and relative to the stance of policy as measured by the level and slope of interest rates. So, those are the first order fundamentals. And of course, asset purchases aim exactly at easing financial conditions beyond such a model. It could be that central banks around the world are going to conduct these unconventional monetary policies by asset purchases for many years to come. And so in retrospect, it might look like there's a structural break in these relationships, basically because risk premia are compressed going forward. And so from investors' point of view, basically what you would say is, well, here we enter the biggest crisis, but the central banks came in to save the day, which people often refers to as a put, right? And so effectively, risky assets are not as risky as I thought. And so going forward, risk premia are going to be compressed. So there's a kind of structural break here. And that's exactly what the evidence is consistent with. But of course, the uncertainty is, well, it might not be a structural break, it might not last. So, and this is, I think, what the debate today is going to be around. So are we going to have a structurally lower risk premium going forward because of these central bank puts? Or is this just sort of like a temporary confusion? So that's number one. And number two, you're absolutely correct in pointing out that these easing of financial conditions really has spread around the world. And from the IMF's point of view, that's a good thing, because we haven't seen as many major emerging markets come to us to ask for programs as we would have expected, say, back in March, right? And based on just fundamentals, right? And so just as US corporations are able to borrow, emerging markets are also able to borrow. So we don't have to act as lender of last resort to as many countries as we thought. It is true that we helped about 80 countries around the world, but those were not exactly programs. So those were sort of like paybacks, temporary paybacks of the capital that they hold with the fund, right? So the fund is kind of like, the IMF is kind of like a mutual, and you can temporarily draw down your capital and then pay back later. So these are not big in amounts. So it's many countries, but fairly small amounts. So
I think at this
yes.
point, Tobias, we
Yes.
have reached, unfortunately, our time for question 2. We'd all love to talk about this for another hour, I think. But let me go on to question 2, which is for Jeff. How have some economies managed to weather the COVID-19 shock better than others? And which are the economies best placed to stage an early and sustained recovery? Jeff, thanks.
Well, it's great to be with you all. I need to, I've got slides as well, so I need to, okay, can you see my slide?
No.
No. Alex, you can't see my slide.
No. I can see you.
Let me, we should have practiced this. I'll get it in a minute. How about now?
Here we go.
Sorry. And now it's full screen?
Yes.
Okay. Well, I'm going to, unless I have time to talk about the financial aspects, I'm going to mainly talk about something a little bit different. How have some economies managed to weather the COVID-19 shock better than others, both with respect to health effects and with respect to economic effects? Clearly, the impacts of the pandemic have hit virtually every part of the globe. I think American Samoa is an exception, but there are not many exceptions. But the point I want to emphasize in my comments today is that the severity has varied widely across continents, across countries, and not always in ways that would have been predicted. Let's start at the biggest level of generality. Surprisingly, the health effects, as measured by death rates, have been better in emerging market and developing economies than in the US, with Europe somewhere in between. I think that's quite a surprise for most of us. Now, of course, there's problems of undercounting, measurement problems, but I think this generalization holds up on average, even taking into account measurement problems. But the economic impacts go the other way, especially looking ahead. The economic impacts will be more severe and more extensive among emerging markets, even though the health effects in many cases will be bad, but not as bad. And the major reason for this, there's a number of reasons, but the major reason is that they lack the fiscal space to respond in the way that the United States has done. Massive monetary and fiscal expansion, as we've just heard in Tobias's session, has helped moderate the economic effects in the United States, and we're able to get away with it, but not everyone is. One of the major points I want to make is that we hear about a trade-off between protecting health and protecting the economy, but I would argue, and many other economists would argue, that this trade-off is illusory. Here's a graph to document that the trade-off is illusory. The horizontal axis is GDP growth. Just about everybody's had a recession. The mildest recession among these countries is Taiwan, hardly any, I say recession, they don't meet the 2 negative quarters criteria, but sharp fall in GDP. Except for Taiwan, it's been very moderate. And take an example, the United Kingdom, it's been pretty severe. The vertical axis is confirmed deaths per million people, and it lines up. There's certainly not an inverse relationship, as you would say if there's a trade-off. And if anything, the relationship is the countries that have managed to protect their economy are the ones that have had fewer confirmed deaths. So that's my quick documentation that there's no trade-off between economic growth and health, unlike what a lot of politicians say. Here is a bar chart showing just in the second quarter, the change in GDP among the G20 countries. India is the worst hit, followed by Great Britain, followed by Spain, followed by Mexico. China is the best off. This is a little misleading because China had its recession in the first quarter. But even if you add together the first and second quarter, China's doing pretty well economically. And then followed by Korea, Indonesia, Australia, and Japan. So the Pacific Asia countries are clearly doing relatively better economically, and others less so. This is expanding the set to 40 countries. Taiwan is doing the best. Peru is doing the worst among medium or large size countries, worse even recession than Spain and the UK. Taiwan, I mentioned, is doing the best, followed by South Korea. Now, why these differences across continents in health effects and in economic effects? In particular, why has Latin America been hit so badly? Because Latin America has, over the summer, registered half of total deaths globally. So Latin America is doing as badly as the United States. Well, among the reasons are they have big, densely populated cities, they have a big informal sector, they have internal migration, which is also a big problem for India, which is badly hit, a lot of inequality, inadequate public health systems. Those are some of the reasons. Why have East Asia and Southeast Asia done the best, which they clearly have to generalize? In part, you might call it a cultural willingness to wear masks or quarantine, but culture is often more endogenous than our instincts allow. Countries and economies in East Asia and Southeast Asia have repeated recent experience with epidemics, SARS and many others. And so they've developed good habits of response. I mean, their governments have done pretty good jobs of managing it, but the people are all ready to go. They know what to do. They have faith for the most part, in what their governments say. As compared to the Western Hemisphere and Europe, which has had less recent experience with epidemics and has less idea what to do about it. I mean, the experts know what to do about it, but it doesn't translate into action as much. Africa has apparently done better than expected, not to minimize the health effects, but and there are measurement problems, but it does appear to be that the death rate is better in Africa than in the United States, which I don't think many people would have predicted. And again, they've had experience with epidemics. I mean, the tropical diseases of all sorts, and AIDS and Ebola and so on. And they have developed good habits of response. They don't have very good public health systems, but what they have, people use. And they quarantine and they social distance to a greater extent than one might have expected. Another factor is low population density. Another factor is a young population, which helps them withstand the effects. Okay, those are differences across continents. There's also differences within continents, which might be more revealing, particularly with respect to policy. One point to note is that the pattern everywhere is that big cities, particularly air hubs, are hit first. So that hit Milan, which then spread to Italy, London, which then spread to the UK, New York, which then spread to the US, Johannesburg, which then spread to the rest of South Africa. So that's clear for pretty obvious reasons. Within Latin America, I said overall they're doing badly, but 3 countries are doing especially badly are Brazil, Mexico, and Nicaragua. And I think the answer is poor political leadership. In each of those three countries, the presidents have repeatedly denied the seriousness of the coronavirus, have downplayed the numbers, downplayed the seriousness, have, rather than encouraging testing and mask wearing, as in East Asia and Southeast Asia, they've actually discouraged these three countries the sensible response that all the experts say, which is widespread testing and mask wearing. Who's on the other side? Uruguay appears to be doing it right. They have had fewer cases, and it's not because they're not testing. This idea that to get fewer cases, let's not test so we don't know we don't have cases. Not only is it not measuring the problem correctly, but testing is an important component of minimizing, reducing the actual true incidence of the pandemic. And Uruguay is an example that's done a lot of testing, but has a low rate of positives. Not everything is explainable. I mentioned that Peru is the hardest hit economically. It's also just about the hardest hit, along with Chile, in Latin America in terms of health effects. And it's hard to say what they've done wrong. At least I don't know what they've done wrong. Well, that's one continent, Latin America. Briefly, to take another continent, Europe, UK leadership did not take the situation seriously enough at first, and perhaps still isn't. And the UK has suffered pretty badly, both with respect to health and with respect to the economy. On the other hand, Germany, I might also mention Finland, but let's take a comparably sized country to UK. Germany's leaders did take it seriously. As a result, the effects have been relatively milder compared to the UK and some other European countries, Italy and Spain. Economic impact, even though the health impact has been surprisingly less severe among emerging markets and developing economies on average, the economic outlook, I think, is worse overall. And in particular, this is due to the lack of fiscal space. The US especially, but also Europe, has been able to respond with unprecedented fiscal spending, in supporting people who are adversely hurt, as well as good old-fashioned macro stimulus and unprecedented monetary stimulus. Now, we heard some of this from Tobias. Initially, from the month from February 20th to mid-March, global investors switched to risk off. This shows up in the VIX, measure of perceived risk. I've got a graph if we get to it or people want to see it. But that's presumably why they pulled out of risky assets, US equities, foreign equities, corporate debt, but especially they pulled out of emerging markets. I'll show you a graph for that. Emerging market asset prices recovered in the spring and summer, but it's not clear, and that is maybe the financial bubble, how long that'll last. And the reason is aggressive Fed easing, as Tobias said, from mid-March. Clearly that turned things around. But how long before the financial environment turns once again against the emerging market and developing economies? And let me mention, that's asset prices. If you look at the quantity of capital flows, it's not clear that they're currently sustaining the ability of developing economies to spend. Possible lessons for policy so far in the pandemic. Countries suffer worse overall where governments downplay COVID-19. These are big lessons. Suppressing statistics, failing to promote masks and testing, and reopening too early after a shutdown. Well, shutting down too late and then reopening too early. And I won't judge whether the motivations are to save the economy or for political purposes. The other one I mentioned, the presumed trade-off between protecting health and protecting the environment, the economy, is illusory, even though some political leaders seem to be acting under this assumption. Alex, do I have another few minutes?
No, let's go into the discussion maybe though, thinking about the financial effects of what you just discussed. We are into our period here for the panel, but Jeff, why don't you talk for a minute about the downgrades of sovereign debt and the IMF lending activity, which Tobias also mentioned.
Well, so I mentioned that, can you see my screen?
Yeah.
So the low-income countries have not had the fiscal space to respond the way the advanced economies have. And here's a graph about how initial levels of debt and how it spreads mean that the emerging market countries are not being given as much leeway by any means as the advanced countries. Here's the magnitude. This is not asset prices. This is the magnitude of the portfolio outflow facing the emerging markets and developing economies. And notice that it's been a much sharper reversal, a much sharper loss of financing internationally in the COVID-19 episode than it was in the taper tantrum or the global financial crisis. And it's not clear that this is coming back as fast as the asset prices. Here is the, I thought the VIX was absurdly low at the beginning of the year, reflecting correctly a lack of appreciation for the risk in the economy. I mentioned this at our April session. And then it shot up to very high levels in late February and early March, but it's come back down somewhat, which presumably accounts for some of the recovery. Tobias had a slightly more up-to-date graph, but you see that asset prices in emerging markets, whether it's bonds or currencies or shares, plummeted in late February and early March, but have mostly recovered since then. But other measures have, and one question is that sustainable or is it a bubble? And another question is that the only measure? Here is a graph of what I think you asked about, Alex, downgrades of sovereign debts. There have been more downgrades of emerging markets in this current episode than in the international debt crisis of '82, the East Asia crisis of '97, the global financial crisis of 2008, 2009. These are over the last 40 years, the worst episodes of debt problems. And by the measure of downgrades by the rating agencies, this one is worse. Should I talk about the IMF or is that enough?
Thank you. I think that's enough. Now let's give the other panelists a chance to get in on this if anybody has a comment or a question. Bill?
I guess.
I think you're on mute, Bill. How do we get Bill off mute here? Bill, you're on mute.
Alex?
Yeah.
In the meanwhile, while you get Bill, perhaps Jeff, the idea with the emerging markets not having that high mortality, isn't that surprising given their population structure? You know, what we've got in emerging markets is populations that are very young. You know, most people are under the age of 25, you know, so it wouldn't be surprising that they're going to have very much lower mortality rates than you're going to get in the advanced countries.
Excuse me, Desmond, let's take that as a question for Jeff, and then I see Bill is ready to go. So after you answer the demographic question, Jeff, we'll go to you, Bill.
I'll answer very briefly Desmond's question. For Africa, the young population helps explain it, but for East Asia, it doesn't. East Asia has the most rapidly aging population. Singapore and Korea are at the top of the international leagues, and yet they've done the best. So that's one factor, but that is not a complete explanation. Okay, Bill, I think we're ready for you now.
Yeah, I'm sorry. The point that I wanted to make is a very simple one, which is it's very hard to determine what the best responses have been with respect to both health and the economy, because both sides of it, there's a very strong intertemporal aspect to it. And so you think, for example, about the health problems. As far as I know, the epidemiologists basically say that this thing will keep on spreading or coming back, call it what you will, until we hit herd immunity if we don't have a vaccine. And if that's going to be the case, then good performance up front actually means bad performance over time. This is the kind of Swedish argument that's been used. And it's the same thing with respect to the economic side, that as we'll get to later on in this program, if we're going to say that you've got fiscal space and you can use it and it tempers near-term problems, but only at the expense of making longer-term problems even worse, then we've got a real question of how do you evaluate what is best? The jury is still out.
Okay, Jeff, a comment, and then Tobias, I know you have a comment too.
Yeah.
Well, I think that's right. And when I said there's no trade-off, it's an illusory trade-off between health and the economy, I especially mean for the longer term in the respect that Bill was saying. I was kind of surprised to look at these statistics and see that for comparable countries, the trade-off is illusory even in the short term to some extent.
Okay, thanks, Tobias. And then this will wrap up this section.
So Jeffrey had this very nice chart where Taiwan was all the way at the end, and Taiwan is a small economy, but of course China is a major economy, by some measures as large as the US or larger, and China has been very aggressive in very fast lockdowns, and it has recovered extremely quickly. So I do think it requires some pause as to whether there really is a trade-off, or whether very aggressive very early isn't in retrospect the right thing. Yeah, that's all I'm to say.
Okay, thanks very much. That's going to bring us to question 3. This goes to Bill White. What are the likely long run economic and financial consequences of our very high debt levels, and what are the policy options with dealing for these elevated debt levels? Just carrying right on, Bill, where you were a minute ago.
Thank you very much, Alex. Let me just start off by with some facts about the question of debt levels. The IIF, the Institute of International Finance, has just published its latest estimates of global debt as a ratio to GDP. That rose to 331% in the first quarter. It increased by about 10 percentage points between the first quarter and the last quarter of last year. The IIF has described this as the largest quarterly surge on record. And of course, it's been surging ever since because of what's been happening since March. So the numbers are big numbers. That increase, it's important to note, is not a new trend. Again, when you go back and you look at these IIF numbers about global debt ratios, they've actually gone up by 50 percentage points of GDP since the global financial crisis started. And not only is that just a huge increase, but it's an increase, and this goes back to the business about the ratings for the emerging market economies. That increase in the global debt ratio is in very large part because emerging market economies, since the crisis began in 2008, have been loading up on debt. So these trends go back a long way. And indeed, I would note they go back to about 1982, when we first started to get out of the Volcker sort of tightening, that when you look at what's been happening for almost 40 years, as the interest rates have been trending down, both nominal and real, the debt levels have been trending up. And this is something that's been going on for a very long period of time. And I would note too that the quality of that debt has also been sharply diminishing. And we've seen this in recent years with the ratings downgrades, fewer and fewer AAA, more and more BBB, a massive expansion, in fact, in corporate debt that's just within the investment grade. And a lot of these loans too are covenant light. In the last 10 years, I think the proportion of them that are rated in that fashion is up to about 80% in both Europe and the US. So huge massive increase in quantities of debt, and also a significant deterioration in the quality. That's the first issue. The next issue is what's caused it. And I guess the line that I would take is that there has been an excessive reliance on monetary policy in the advanced market economies for many, many years. They decided about 20 or 30 years ago that fiscal could no longer do the job, so it was the job of monetary policy. So every time there's been a downturn, or even the threat of a downturn, monetary policy has eased pretty massively. And so we saw this in the Greenspan put in 1987, 1990, 97, 98, 2001, 2008, and here we go again. And every time this has happened, of course, it's an invitation to more private sector debt. And that's precisely what's happened. In the emerging market economies too, these low interest rates, as they've ratcheted down and down, has also encouraged them to build up debt. And the way in which it's happened, and this goes back again to what we were talking about earlier on about everybody's doing it, is as the advanced market economies tried to lower their interest rates and expand their economies, the exchange rates started to go down and the exchange rates of these other guys started to go up. And of course, they resisted this through both easy money and foreign exchange intervention. And so now this problem, this debt problem, is not just a problem of the advanced market economies, it's a global problem. And the governments too, although the fiscal authorities have not used their fiscal policy in quite the same counter-cyclical way, it's just a simple fact that when you go back over the course of the last 20 or 30 years, that the easing that took place during the downturns was never matched by a symmetrical tightening in the upturns. So in the same sort of way as the interest rates have ratcheted down cycle after cycle, the debt ratios of the governments have been ratcheting up cycle after cycle. So that's basically what I think has happened. A more profound question is why the monetary policy authorities reacted the way that they did. And I think there's been two fundamental analytical errors. One of them is that they have not appreciated that the buildup of debt over time is a headwind that eventually slows spending. So you're heading to a kind of stagflationary environment through being on this particular path. And the second thing, and maybe Tobias could comment on this, I think that they fundamentally underestimated the importance of supply side shocks. And so we had that whole period leading up to the Great Moderation, and the crisis of 2008, where you had very limited inflationary pressures because of positive supply side shocks, like China and Slovakia coming into the world trading system. This did not demand monetary easing, but monetary easing is what it got. And the upshot of the whole thing is it's created all of these bubbles, like we talked about in the first session, the asset prices, the credit spreads, and all of these things that in the longer term will come back to haunt us. Well, the next question, I guess, is what are the likely consequences of everybody having done what they've done? For a starter, I think we're now at a point where the debt levels are such, to say nothing of the likelihood that this virus is going to be around for a long time, is that prospects for real growth going forward are going to be really quite limited. Whether that will prove disinflationary or inflationary seems to me that the jury's still out on that. I would just note there's a new book coming out by Charles Goodhart, who was my first boss at the Bank of England many years ago, in which he argues, I think, with his co-author, very convincingly that the demographic trends that prompted the positive supply shock in the past are now turning into negative supply shocks going forward. And this is going to be sort of fundamentally inflationary. Anyway, whether it's going to be inflationary, deflationary, real growth going forward is going to be very hard to sustain at anything like normal levels. I think the upshot of that will be that fiscal and monetary policy will double down because it's what they've always done. There's no appetite amongst the central banks, as far as I can see, for near-term tightening up or even longer-term tightening up. All sorts of arguments coming out now about how fiscal policy should be used. There's lots of room for maneuver. The examples of Japan, modern monetary theory. I think everybody's going to double down. And then the question becomes, what comes out of that? And there I'm not very optimistic, frankly, because on the one hand, it might not work, in which case we're going to have an extended period of very, very low interest rates and gradually growing fiscal sovereign debts from levels that are already unprecedentedly high. So those things going forward are going to cause problems. And what I worry about most is the financial system. So that if we do have a period of very slow growth, all of those asset price increases that we talked about before are going to disappear. The spreads are going to widen back out again. Financial institutions are going to be left with no viable business model at these very, very low interest rates for an extended period. So if the economy doesn't recover, and I think it won't, we're going to have a problem. Even if the economy does recover, those levels of debt create problems regardless. It's better than the no recovery thing, but to think we're out of the woods is delusional. Because if the economy comes back and the inflation starts to rise, as is entirely possible, then the increases in interest rates will start to expose all of the exposures that are already out there related to the debt and the imbalances and whatever. So I am concerned about where we are, both in the case of the economies not recovering and in the cases of even if they do. Now, what are the policy alternatives? For a starter, we know fiscal austerity doesn't work. You know, you can't take the example of a household and gross it up to an economy. That's where the Keynesian, the paradox of thrift cuts in. So that's not going to work. Faster real growth would be helpful for reducing debt service burdens, but it's almost an oxymoron to have faster growth when there's no demand there, because the debt is acting as a headwind against that demand. So structural reforms clearly would be advantageous. But unfortunately, that's going to take a lot of time, and there will be a lot of political resistance. The last thing that I guess we could do by way of making things better is debt restructuring. I think there's an awful lot more attention that needs to be paid to debt restructuring, particularly corporate debt restructuring. Just in the last little while, we've had WP1 at the OECD doing a lot of work on this, the Group of 30, the IMF itself. Everybody basically saying is that our procedures for dealing with debt restructuring, our procedures for ensuring we have orderly debt restructuring as opposed to disorderly debt restructuring, those procedures are profoundly inadequate. And there should be an awful lot more attention being paid to those kinds of issues. Public sector debt, in a sense, restructuring is even worse. And I'd cede to Tobias on this. As I understand it, there are no agreed criteria for when debt restructuring is required. There are no rules that prevent people from actually giving loans to people whose debt is already unsustainable. Think about Greece. So there's a lot of issues there. And I guess I would just summarize by saying there may be some palliatives out there to deal with the debt overhang problem, and we should proceed along those lines as vigorously as we can. But I think looking at all of this, the longer run implication, because it's always been the longer run implication of debt overhang, is that we will get, after a period of disinflation, we will have a period of inflation and perhaps a significantly higher inflation. That would be my worry.
Thank you, Bill. We do have a question coming from the audience that builds right on your comments, which if there is a period of inflation or stagflation, but inflation with presumably rising interest rates, so you would get a market value as well as a solvency challenge to asset prices. You mentioned the risk to financial institutions. Of the various kinds of financial actors, which types might we think are most at risk in this potential world going forward?
Well, I think if the interest rates do start to go up, clearly the people that you would have to worry about most will be the corporates that have become highly indebted, and an awful lot of corporate debt, sort of triple B, just above investment grade, could easily be downgraded in the context of a weaker economic recovery. And then the question becomes, who do you think is exposed to that kind of debt? And unfortunately, and I think the FSB has been pretty frank about this, is that when you get into the question of who actually holds this stuff, it's not entirely clear, particularly too because a lot of it has been bundled up into CLOs and the rest of it. So the answer is I'm not entirely sure. What I would worry about, and I think this is typical of sort of financial crises, is that the area that you want to look at as being most exposed is the area that's grown the most over the course of the last number of years. And there, of course, it's been the shadow banking system, variously defined, that you would really want to worry about. But the problem, just to repeat it, the problem, of course, with shadow banking is by its very nature, it's shadowy. So it's hard to say who exactly is going to be on the hook.
Thanks, Bill. Let's open it up. Other comments from the panel?
Yeah, I'm happy to come in for some of the issues that Bill raised, and he mentioned my name, I think, twice. So the first is about monetary policy, and of course, this shock was both a supply and a demand shock. And in fact, we had some debates within the IMF about whether it was more of a demand or more of a supply shock. And what you saw in the first couple of months was inflation that went down pretty dramatically, partially because, of course, oil prices also collapsed. So it was also an oil shock as well as a COVID shock. And so break-evens as well as surveys really fell pretty dramatically. So from a pure narrow inflation targeting point of view, that would have given you sort of like the excuse to ease monetary policy. And indeed, we saw easing around the world, including in the emerging markets. But of course, there are trade-offs, and this is what Bill alluded to with respect to risk-taking, right? Now, when you ease monetary policy, one of the transmission channels is to increase risk-taking, and the danger is that there's excessive risk-taking. Now, one of the silver linings of this crisis is that the global banking system is in pretty good shape, right? Because we spent 10 years reforming the global banking system. So there's a lot more capital. And in October, we're going to publish a global bank stress test where we basically stress the GSIBs, but also a couple hundred other banks around the world in 30 of the largest economies and emerging markets. And on average, they look pretty good, but of course, there's a weak tail. That weak tail is concentrated in some countries. So it's not all good, but sort of like in the aggregate, it looks pretty good, but then there are some weak tails. So the question is, do you control risk-taking? And I think in the banking sector, we have learned the lesson we have to control risk-taking. But this crisis is much more about the corporate sector and the sovereign sector. And this is where we don't have risk controls, right? In the corporate sector, I mean, there are no prudential standards in the corporate sector. And market discipline doesn't really constrain risk-taking corporates. And of course, as Bill mentions, there are lots of ways to sort of like take on more and more debt. This is one problem. And the second is on sovereign. I mean, there are no prudential limits on sovereign risk. So at the IMF, we do debt sustainability analysis. And that gets to the last thing that Bill mentioned. So we can only lend to countries that have sustainable debt. So there are some countries out there that would need an IMF program, but we cannot lend to them because their debt is deemed unsustainable. And our shareholders, which are the 190 countries that have given us their capital to help countries, they basically say you cannot take too much risk. So you cannot lend into countries that have unsustainable debt. And so, yes, but our politicians forward-looking enough to say, well, if ever things go bad, then the IMF will only come in if that is unsustainable. Well, it doesn't work that way. So, as you say, there's no prudential force that limits sovereign risk-taking.
Other comments from the panel?
I guess I've got a question for Bill. Bill, you mentioned debt restructuring, that we should really explore it a lot more, in the corporate sector. But my question is, wouldn't that have a huge impact on bank balance sheets? So that banks, what you'd just be doing is you'd be shifting the problem from the corporates to the banks, and then in the end, the sovereign is going to have to come and take it on its balance sheet. It's the only balance sheet that is viable. So my question is, if you've got a lot of these corporate defaults, what do we do with the banks?
No, I think you're absolutely right on that front, Desmond. I hear a lot of people talking about debt jubilees, for example, but we go back to ancient times, it was the king and a few people around the king who basically, gave the jubilee, waived their rights to be repaid, and then went on living exactly as they did before. But it's totally different today because, as you say, if you write off some of these debts or restructure them, somebody else who thought they had wealth is now realizing that the wealth is totally illusory. And in cases where it's the banking system that is going to be most affected, then it may well be that debt restructuring is actually going to cause more problems than it's worth, and that inflation, as painful as it is, might be a better alternative. So there are some real issues there. There's no question. And
that would be an implicit. Oh, I'm sorry.
I was going to say, if you're starting to think about the political implications of all of this stuff, and of course, we really always should be thinking about the political implications of the economic developments. What happens when the pension funds start to take big hits and all of a sudden the pensions don't get paid? What are the political implications of those sorts of developments? So yeah, as the old joke goes, if I were you, I wouldn't start from here.
Thank you, Bill. I think with that, we're going to go on to the next question, which will be for Desmond. And it is, speaking of sovereign debt, as we just were, how likely is it that we'll have a sovereign debt or financial market crisis in the Eurozone and also in emerging market economies that could have spillover effects to everybody else? Desmond.
Thank you, Alex. The reason I think it's worthwhile focusing on, both the Eurozone and the emerging markets are really the size of their debts. And if one looks at this, then I would take issue with Tobias that, basically we don't have just a corporate problem. We've also got a sovereign problem. If we look at the Eurozone and we look at the emerging markets. And what I would say as well is, I share Bill's pessimism as to where we're going on this debt issue, because I would think that we're really going to have a whole lot of defaults, that if we look just at the United States, if you look at the real commercial property market, we've got like $1.5 trillion of debt there. We're going to have buildings that are empty, that you've got a structural problem that we've really got to deal with, not to mention, the high yield debt. We've got another $1.5 trillion there, so we've got real problems in the United States. But my contention is that those problems pale in relation to what we've got abroad. So if I look at the Eurozone and I look at the emerging markets, if I just take the Eurozone, I just take one country, like Italy. Italy's got something like $2.5 trillion of sovereign debt, and it's got a weak banking system, so that is really a very big number. And then if I look at the emerging markets, we're talking about, forget about that, they've got $71 trillion overall debt. They've got $3.5 trillion of external debt, US dollar denominated debt, that they're in trouble. So one of the reasons I think it's worth focusing on these is just the very level of the debt. The other question is that the debt situation in both European markets, both the Eurozone and the emerging markets, is a lot worse than it was in 2008, 2009. So if we look at the emerging markets, their debt to GDP levels are going up from something like 90% to 110%. If you look at the European sovereign debt crisis, those countries went into this crisis with their debt levels not having been worked down from where they were at the end of 2012. So they went into this with debt levels very much higher than they did in the 2008 crisis. Now what we've got is we've got a recession in both Eurozone and in the emerging markets that we've never seen anything like this before, that it's something like 3 times as bad as we had in 2008, 2009. So we've really got a problem. We've got too much debt. We went in with too much debt. Now we're going to have a very deep recession. It's not very clear how these countries go out of the recession. So my problem is that we've really got going to be getting a lot of defaults. Whether you pump all of these countries up with more credit, you're just compounding the problem. The underlying fundamentals of these countries is such that the debt is unsustainable, which means that at some point they're going to be defaulting on these debts. So let me just illustrate what I'm saying about both the Eurozone and the emerging markets, just taking one country of each. So let me just take Italy, for the Eurozone, and you can just see how intractable this is, that this is now well on its way to being a totally unsustainable debt situation. But I should just stress that Italy is not the only Eurozone country that's in deep trouble. That if you look at Spain, which is another one of these big countries, so to keep propping these countries up is going to require literally trillions of dollars. So just looking at Italy, according to the IMF, that even if you don't have a second wave of the pandemic in Europe, and now it looks like we are getting the second wave, even if you don't get that, Italy's economy is going to contract by something like 12% in 2020. As I said, that is like the 3 times as bad as it was in 2008, 2009. And what frightens me a lot is that it's 3 times worse than the worst case scenario of Italy's bank stress test. So the Europeans did bank stress tests. They did the worst case scenario was something like a 4% decline in the worst case. And now we've got a 12% decline. So you've got a banking problem there. With Italy, what's occurring is that they went into it with a debt level of something like 135% of GDP. Their economy's declined by 12%, and their budget deficit has blown out to 10% of GDP. So just arithmetically, Italy's way over 150% of GDP, stuck in a Eurozone straitjacket where it can't use the currency to offset fiscal tightening. I don't see how they reduce that budget deficit very much, without sinking the economy further. So they're in the same kind of debt trap as they were before. So this is a totally unsustainable situation. Overlay that with a banking crisis that they're bound to have. If you have 12% of GDP decline, you're going to have non-performing loans up to the wazoo. They've got a load of Bank of Italy, they've got a load of Italian government bonds on their books. They've got a banking crisis and a debt situation that's impossible. Now, the only thing that can save Italy, and that what has been saving Italy, is the ECB. So the ECB now, the last couple of months, or should I say in April and May, they were buying the equivalent of the government's gross financing needs in the secondary market. Now, theoretically, that can go on forever. But, I just point out that Italy is 10 times the size of Greece. It took $300 billion to save Greece. It's going to take trillions of dollars of euro money to save Italy. Now, as I say, it can go on, but Italy's going to have to be bailing out Spain and Portugal as well. And what makes this even more complicated is that unlike in 2012, when the ECB did bail out Italy, they required conditions. They installed a new technocratic government that they got Italy to do some structural reform. This isn't on the cards now. So I just think that at some point, the Germans are going to get tired of this, and the German Constitutional Court has already indicated that it's not sure that the ECB is operating the way in which the Lisbon Treaty had in mind. So I think that we're really on our way to real debt problems in Europe next year. Just finally, just short word on Brazil. It's the same sort of story. That Brazil goes into this crisis with a debt to GDP level of about 80% of GDP, which is extraordinarily high for an emerging market economy. Now its economy tanks, its budget's blown out to 10% of GDP. They're well on the way to 100% of GDP. Their crisis that we're already seeing, their currency having depreciated by 25% since the start of the year. The only thing holding this up is the flood of liquidity globally. So my contention is that this looks to me like a house of cards. As soon as the risk of trade is on, we're really going to get problems. We're really going to get problems all over the place on the emerging markets and Europe. So bottom line is, I think that we really can't ignore these storm clouds that are gathering abroad. I don't see how the Fed is going to keep this show going on indefinitely. And my conclusion would be is that now's not the time for the United States to cut back on the stimulus measures. If there are reasons to have stimulus domestically, they've really got to contend with problems They've really got to contend with problems in the rest of the world. So, now is not the time to stop the stimulus. So, Alex, basically, I'm pretty much in agreement with Bill that we've really got long-term debt problems that I'm not sure that I see how we're going to resolve them.
Thanks, Desmond. Of course, the main question for you would be, what's the good news? Never mind.
No. The good news was that was my baseline scenario. I haven't told you my downside scenario.
We have a couple of questions from the audience. I'd like to take one now, and then we'll go back to the whole panel. With the lack of good news of Desmond that you have been talking about. One of our audience members writes in, with all this going on, what is the chance that the debt of the United States itself could be unsustainable? Can the U.S. debt remain sustainable, and what are the factors one might think?
Well, the big point that I'd mention, what distinguishes the United States from the countries I've been talking about, is that the United States borrows in its own currency, and the Federal Reserve is always there to finance the government. So, the question isn't whether the United States is going to default. It's more the question, that I think Bill has got in mind, is whether the United States is off to the races in terms of inflation. So if the United States keeps running large deficits, if people don't want to buy the debt, the Federal Reserve is always there to print the money, and you'd get the inflation. That is not true. That is the problem, for the Italys of the world that are borrowing money that somebody else prints. So they're at the mercy of the European Central Bank to come and buy their bonds. So I'm not concerned about the United States defaulting. I'd be more concerned that the United States is on the way to inflation. And, I think that the latest move of the Fed, just seemed to me bizarre, to take that you're talking about long-term, nobody's concerned about inflation. So now the Fed has decided to say that we're going to keep interest rates low for the next 3 or 4 years.
Okay, other comments? Anybody want to take up again the inflation? the inflation threat or even stagflation, as Bill suggested? Jeff? You're on mute, Jeff. Can we get Jeff off mute? There we go.
Yeah, sorry about that. We think we have enough experience with this by now that we would know. So Desmond, you're worried about inflation and that it might go above 2%, but we should flag that this, as we all know on the panel, that this has been a fundamental policy shift, at least purported to be on the part of the Federal Reserve, that they actually say we welcome the notion. We hope that people believe that we'll have a period of inflation above 2% to average out with the period of inflation that's fallen short of our 2% target, which has basically been the last 10 years. I mean, if you take it literally, the average inflation targeting, they want inflation to be, maybe in the range of 3% for 10 years, because it was below 2% for 10 years. Now, I don't think, and more practically, that they're just signaling that they're just going to keep monetary policy very easy. I don't think this change is as important as some of the people who live in the world of monetary policy think it is. I don't think the public has a notion of expected inflation and relies on it that heavily. But the discussion did seem to leave out the view that a higher inflation rate is desirable. I'm not arguing that myself, but it is sort of a majority of the view among both academics and the central bankers and financial types, is that an increase in inflation would be desirable at this point.
Tobias had a point here.
Yeah, just two thoughts on monetary policy and debt. So the classic issue here is that when public debt is very high and inflation shows up, then tightening monetary policy can generate default of the sovereign, right? And so then the question is, what's the governance of the central bank? Is the central bank going to be independent enough, so to say, to raise rates, even though it puts the sovereign at risk? And one might argue, is that even the right thing? You keep inflation low, but the sovereign goes bust. And so you might end up in a situation where there are really only bad outcomes at the end of the tunnel. And I think this is what Desmond was talking about. I did want to come back to the debt restructuring question and just make the point that, I mean, corporate and sovereign debt restructuring is fundamentally different, because corporate debt restructuring is guided by bankruptcy codes. Like in the US, we have a very good bankruptcy code, which is Chapter 11, which has a lot of protections so that you don't have these inefficient liquidations. But of course, at the global level, there's no bankruptcy protection. And there are many inefficiencies. Unfortunately, there are no low-hanging fruit. In fact, back in 2014, there was a very important change in the global debt that has been issued. And so there are collective action clauses now that are overcoming some of the hold-up problems. But only about half of total outstanding sovereign debt is subject to those collective action clauses, which is why you still see a lot of time spent to get to debt negotiations at the sovereign level.
Thanks. Bill, we're waiting. You got to get your mute off, Bill.
I was going to say something in response to Jeff's comment. And, the idea that the Fed wants everybody to believe that inflation is going to go up, and this will have positive effects on spending, et cetera, et cetera. Well, they want everybody to believe except the bondholders, because if you don't keep the bond rates down, then what the Lord giveth, the Lord taketh away. So the question is, can you actually efficiently do the kind of financial repression in today's world that governments did, the Fed and the UK and whatever in the post-war period, where financial repression together with higher inflation just gradually ate that debt away at the expense of people who perhaps didn't even notice that they were losing it. But could we reasonably expect to do that today? And if you get into a kind of race where the rates are going up, even as the bond rates are going up, even as inflation is going up, then what may be the outcome of that race is at the end very high inflation indeed, because it's only the unexpected component that's actually doing the good of reducing the real debt burden. And we've seen this many times before. So when you talk about inflation in the States, if you could get moderate inflation and keep it there and keep the interest rates down, this is the best of all possible worlds, I think. The question is whether this situation is controllable.
Yeah, thanks, Bill. This maybe takes us to a question which one of the members of the audience posed, which is, if we picture the kind of a world, Bill, that you just were talking about with high inflation and the bondholders losing faith in the bonds, is there any chance, one of our participants asked, of a loss of faith in the dollar itself? Is there a risk of the dollar's loss of its international role, and what might that entail, or not? Any thoughts on that?
Alex, if I might just say, on just responding to Jeff, my concern isn't so much with inflation as more with deflation. That if I'm correct, that we're just going to have a whole wave of defaults, we really are going to have downward pressure on prices rather than upward pressure. So deflation, I think is a greater concern with all of this defaults likely to hang over us. And if that occurs, that might be good both for the long-term sovereign interest rates, that there'll be this flight to safety. That might be a reason why, the dollar will be a bid. And the only point I'd say to the viewer is that there are plenty of reasons to doubt the dollar, but you've got to be comparing it to other currencies. However bad the United States is, Europe looks to me a lot worse. So, I wouldn't say that the dollar is going to be depreciating against the European countries. It's a question of relative, what is the least ugly of the economies around the globe.
Tobias, you have a comment?
Yeah, we have seen in this crisis again that when the world falls apart, investors flee to the dollar. I mean, that hasn't changed, and of course, this is partially reflective of the very deep capital markets in the US, and there's just no country that can compete with these capital markets. So I don't see this changing anytime soon. And of course, I mean, the dollar is a reserve asset. So, I mean, even with increasing debt, the Federal Reserve, of course, is buying, but also central banks around the world are buying the dollars. So there's a lot of demand out there.
Thank you. Gentlemen, this has been a great discussion. We've got about 2 minutes left. How about any parting thoughts, summary points that anybody wants to make?
I guess just to respond to the last set of comments, for years when the U.S. started running record budget deficits and current account deficits in the 80s and resumed it in the early part of this century, for years I was on the side of those who said that that's going to be unsustainable. We got the retirement of the baby boom generation upon us, and deficits in Social Security and Medicare, and this can't go on. I've actually since the global financial crisis of 2008, I've abandoned that viewpoint, and as Tobias says, then and now, every time there's an increase in risk and uncertainty in the world, even when it originates in the United States, there's a flight to quality. They pull out of the emerging markets, they pull out of the junk bonds, they pull out of equities, and they go into U.S. Treasury bills. And that, I'm not saying that if we try hard enough to screw things up, that we couldn't lose our exorbitant privilege of having the world's #1 international currency, the way the Great Britain did in the 20th century. But I don't, as of now, the world seems to have not diminished at all in its limitless desire to hold U.S. Treasury bills, even if they pay low interest rates, and regardless of the value of the dollar.
Thank you, Jeff. Desmond, right at the end, I think you get the last word.
I guess that I would just echo what Bill suggested, you know, that probably the solution to this is to have started from a different place.
Thank you, Desmond. Thank you all for a great discussion.
Thanks very much.
Yeah.
Thank you very much, Alex.
Very good to see you all.
Thanks to all participants outside for joining us. Thanks again, Desmond.